All right, so we are live here with a good buddy of mine. We got Billy Libby, who's the co-founder and CEO of Upper90. I got to spend some time with him in person maybe a couple months ago, I think before the holidays. But he's a New York OG like me. We know a lot of the people that have kind of built the New York tech ecosystem. And just excited to kind of get on the horn with him and just go a little deeper on what he's building and what he's built over time. And then we're probably going to do some more community building in person with some of the other leaders in the ecosystem. But I'm just going to do a quick overview, and then Billy's going to go a little deeper into his background, and we're going to cover a couple hot topics with all that's going on in the news. But Billy Libby is the co-founder and CEO of Upper90. They're a leading hybrid investment firm focusing both on private equity and credit strategies for high growth companies. With a background in trading and risk management, Billy leverages data-driven strategies to support founders in building successful, sustainable businesses. Upper90 has backed numerous successful startups, companies, and continues to innovate in the venture capital landscape. So welcome to the show, Billy. Thanks for making time for us.
A great introduction. Thank you.
Thank you. I memorized the whole thing, didn't read anything at all. But, why don't you unpack the intro? Just tell us a little more about your background, where you went to school, where you grew up, and, how you kind of built these platforms and communities around investing.
That's great. So thanks so much for having us. It's been fun to spend time together recently. I grew up in the DC area, went to school in Philadelphia, and went to New York, and was really fortunate to get trained, on Wall Street and get exposed to technology as a Goldman. And we were really early in what is now common, like high frequency trading and quant trading. And it was a really good way to see the impact of technology. And as that became more scale oriented, I really felt the innovation was happening in the tech world. And I think when you start in finance, it's hard sometimes to move to that other industry. You have to start over, or you have to start something. So I think it took a lot of time to figure out, like, what are some of the problems or ways that my background can help add value into that tech ecosystem. And I met my partner, Jason Finger, who had started Seamless Web and Grubhub. And, he said, look, there's a lot of these startups that have revenues, or they have equipment, or they have some receivables. And it's just not common for that audience to use credit. It's very much like an equity-driven narrative. And we partnered up because I said, look, it's all about sourcing. How do you find these opportunities? Like, it's not rocket science to underwrite these deals. It's finding them at the right time. Probably like a wealth manager. They have to find that person at the right time before they go public and Goldman and JP Morgan come after them. So it's all about sourcing. And so I thought Jason would be a great partner who has access to that startup world, look like your customer. And then we built our LP base around other founders. And, if you have an interesting company with a complicated capital need, call Upper90. So that was kind of how we've evolved and built the firm.
How'd you come up with the name Upper90?
So I played soccer growing up. I played soccer in college. And, it was this, my wife, I think, actually helped me think of it. It's the top corner of a goal. So it's these like niche-y, hard to hit, skill-based deals. And one thing that I've always felt is these strategies, like everything in life, are often capacity constrained. And in private credit, it's like boomed. Since we started in 2018, we had to explain private credit. It wasn't very common. Now it's very common. You have to explain why Upper90. But I think so many firms that I see are just trying to build bigger and bigger and bigger funds. Unless you're the biggest, I think you end up creating like a competitive disadvantage. You're going after the same size deals without a low cost of capital. So we've kept our fund size pretty disciplined and small, and we can do $10 or $20 million deals, which is in the credit world, not that big, and nobody wants to be bothered with it. So
I think that's a huge edge too, when you can kind of go after a certain gap in the market. I would say just advice to emerging managers, right? I mean, it's sometimes the less sexy areas where you play in, or just the areas where just there's just a huge gap, right? There's super early, and then there's kind of like super late stage, and private credit, where those deals are minimum, 100 million to probably 250 million. So if you can find that unique edge, and then that's the edge where you can kind of do really well in, I think that's kind of where you can carve out as an emerging manager. Tell me a little more about your, just backpedaling a little bit. Tell me a little more about your education and, that time. I think you went to Wharton as well, right?
I did.
So with your education, that cohort of graduates, what were they pursuing? Were they pursuing just private equity jobs or looking at consulting? Because one thing that you mentioned was really interesting, where there was a convergence where people that were working in banking, especially in 2008, a lot of those people just got burned out and they went into tech, right? They were trying to become a product manager at Airbnb. So, maybe just walk me through a little more of that ecosystem when you were kind of playing in it, and then how it's evolved. And, now with everything that's going on in the market, what are some things you're seeing?
Yeah, it's a long time ago now, so I'm trying to think back. And I think something that worked well for me was just being open-minded and taking advice from other people, and just trying to solicit that from the smartest people. To be honest, when I graduated high school in 1999, I didn't actually know that the Wharton School existed. Some people were obsessed with business. So when I applied to UPenn, my dad's like, "You should apply to Wharton." I'm like, "What's that?" And he's like, "Here's why you should apply." And I'm very lucky that I did that. When I graduated, when I was interviewing at Goldman, they were the one bank that said, "We see more of you at 21 than you see of us. And so if you're a good fit for the firm culturally, we will decide where we think you'll have the greatest impact." And every other bank at the time that I interviewed with, UBS, Morgan Stanley, you have to apply to like the FX trading desk or the high yield desk or the equities research sales group. And at that age, like, how would you know, that even some of these ecosystems existed? So I think part of it was, figuring out, trusting people that have more experience and can direct you, and just being the best that you can be at that role. And if you do that, you kind of get other opportunities. But for me, I think it was really helpful to have some of that structure. Like, I think I applaud all these entrepreneurs that are, jumping in at or right after college into, kind of this unstructured ecosystem and creating structure and outcomes. I'm just unbelievably impressed by that. And that's kind of like something that drives Upper90, and Jason and I talk a lot about, is the people that are taking that risk and betting their lives should end up having more of a financial outcome than the growth equity or private equity investor that comes in late when it's de-risked. And so that's part of like how you set up your balance sheet, and how you think about using credit gives you a lot more optionality and rewards the people taking the most risk, which is the founder.
Yeah. And walk us through, where you're allowed to, just kind of a typical deal where there's a hybrid of credit and some equity, right? So are you kind of coming in with, when you have your term sheet, I guess I'm assuming there's kind of those dual terms in there, which offer some type of interest product, I'm assuming, and then, obviously some ownership as well. So maybe you can walk through that, and then kind of the typical companies or the stages of the revenues that you're looking for.
Well, I think, first off, like, the world doesn't need another venture capital firm. So we really try to solve that role of being that initial credit provider, which is pretty tough to get.
Sure.
So that's really what we try to lead with and focus on. Where I think the term hybrid comes in is the typical lender is viewed as a temporary partner or a temporary capital provider. They provide capital usually for a year or 2 or 3, and they move on, and they get some warrants for kind of that service. And what we found is we want to be aligned with our companies. And so when we provide the debt, we often will invest up to 10% of what we do in debt in equity. And I always tell founders, like, if I was starting a business, I would almost demand that my lender had some skin in the game, because often when things go wrong, it's like that's the opportunity for the lender to act, across the table. And so I think you want to create some alignment, which I think we can accomplish through equity in smaller scale. But we really always want to see that there's a lead equity and that there's other capital supporting the business, so we're not on both sides of the table.
Sure. So you try to find some partners, upstream and downstream as well.
Yes.
Yeah. And you guys have done. Go ahead, Billy.
No, go ahead.
Yeah, no, I was just gonna say you've done a lot of fintech deals, and we've got some common friends from New York in the fintech space. So
Absolutely.
outside of fintech, I guess what are some other sectors when you talk about asset heavy industries, right? Are there some companies that actually have physical assets as well that you think are attractive with this
Sure.
kind of model?
Yeah, I think one of the things that we always, if I think the two things that we try to improve on and have room to improve is one, how do you describe the typical deal for Upper 90? Because as credit, you can solve probably a wide variety of problems, and trying to make it easier for people to send us deals and explain what we do. That's one. Number two is we, as companies scale, we just did like a multi-$100 million upsize for Crusoe, which is building AI infrastructure, data centers, cloud computing. We've been financing their NVIDIA GPUs for several years before it was a well understood asset. And they've had a lot of success, needed to grow, outsize our LP base. So we brought in some other institutions that could help us scale with the company and kind of play that capital markets role, which is really time intensive for founders. So I think one thing for us is like, who would be the ideal partner for us that as these companies scale and need lower cost of capital, and we're already there, how do we kind of grow and have somebody who already has that insurance capital or that bank capital? But so that's just one thing we're thinking about. So we can stay in our trades longer as they de-risk. But the types of deals that we're looking at are still pretty broad. I'd say there's three main buckets. One is fintech and some of these niche industries. So we just completed a deal in a company called Sunbound, and they build software for independent nursing homes. So nursing homes, 60% of their payments are in check. It's almost like probably, when Seamless or Toast helped restaurants go online and organize all their data. That's what Sunbound does for the nursing home industry.
Sure.
And they have really strong recurring software revenue. FICA led their last round. They just are now going to raise another equity round. And one of the needs that they found for the nursing homes is that often somebody takes a nursing home bed and they get paid 60 days later from insurance. So they need that working capital. So they were introduced to Upper 90 to help factor that insurance receivable. So it's kind of finding these niche industries where we can, kind of bolt on a finance product. That's one. Two is companies that have kind of unique equipment. So Crusoe is a great example where NVIDIA GPUs weren't really well understood yet. We're talking to a humanoid robot company in Texas that has signed some enterprise customer contracts and now need to finance that delivery of humanoid robots against those contracts that are in place. And the third is just interesting roll-ups. We just financed a company that's doing an accounting and tax services roll-up and wanted to do some additional acquisitions. So I think those kind of are the three major buckets that we've been focused on over the last few years.
Yeah, no, that's amazing. And I know we got about 6 minutes left. And I noticed that you said the word AI, and you can't have a podcast without, talking about AI, right? I mean, so look, we talked about, a few years ago, everyone talking about LLMs, and then it was co-pilots. Now everyone's talking about agentic, right? So I guess, where do you think AI is headed? One trend that I'll say in fintech is just kind of the interesting trend with Robinhood, right? Robinhood is slowly eating the bank, right? So as software eats the world, they're taking off little pieces of different workflows of the bank, right? When it comes to wealth management, when it comes to credit, and just kind of thinking about a holistic plan. I think that's kind of interesting. And then I think there's agents that can support that. So I don't know if you see any industry trends or just kind of things that are leveraging agentic, and then, what do you think is going to be the buzzword in, 18 months?
Well, since you mentioned Robinhood, it just makes me think when I started my career at Goldman, I left to go to the buy side. I came back and really wanted to do something entrepreneurial, and just it all hadn't clicked yet for me. And I was introduced to Robinhood when it was a seed kind of pre-revenue idea. Was offered the role to be an advisor there. And then I went back to Goldman, where you're not allowed to, spread your time. And so I had to tear up that advisor agreement, which probably would have been worth a lot more than, going back to, but it's funny. on the AI stuff, I think where we can play the biggest or add the most value is just on the infrastructure side. Like I'm not smart enough to keep up with all the trends and buzzwords. And, I think a lot of people have been using these tools in the quant world for a long time.
Yeah.
And so there's no like free money. There's no, if a company goes from 0 to $100 million, it can also go back to 0. Like, so I just feel like we believe that there's like, it seems that there's a need for energy to power all of this. And there's a need for like compute equipment, and NVIDIA kind of reminds me almost like where the iPhone was, in the middle of almost every industry. It's going to be hard to disrupt them. So I kind of feel like instead of trying to pick each company and, Perplexity or this or that, like, or Anthropic, like buy Exxon, buy NVIDIA, and like invest in companies like Crusoe. So I think it's really hard to pick. Like the only area that we're focused on is, some of these roll-ups where you can buy an offline business. There's a function that really can be automated or consolidated, and, you can improve margin that way. So I don't know, that's kind of where we're more simpletons, like, buy a good business and you can improve it versus like having to kind of split the atom.
And then real quick, when you're looking at the financials of a company, what are some KPIs that you've kind of used in your diligence process? Is there a certain threshold for, profit and EBITDA? I guess, what are some of the things on the financials that you look at?
Sure. So we want to make sure they have like a relatively simple balance sheet. That's why I think it's really important for founders to, do you need 6 VCs on your cap table? Especially if you're a capital intensive business, probably not. Pick 3 and pick one Upper90. Like, you just want, so we look for simple balance sheet. We don't want to be like mezz debt. We don't want to be off balance sheet. We want to have like, kind of a simple alignment with the company. That's just number one. Number 2 is that you want to make sure that the company like is able to make good unit economics, or it's like often referred to as excess spread. So like how much are they making on their loans versus how much they're paying? And so you just want to make sure that there's some cushion there, that they're able to earn enough yield or enough return so that they can withstand some of like the market shocks, like tariffs or tax increases or competitive changes. So if it's too tight, I think it just leaves, you have to be too perfect in terms of pricing. And then I just think, making sure that the company is, not over levered. They, have the right amount of debt to equity. And, if they're doing acquisitions, they're not paying too much for assets. Real estate, it's like 90% the buy. So a lot of it's just like looking at kind of the leverage profile and making sure you're not overspending, because it's, then it kind of puts more pressure on capital markets and ability to raise equity, which we can't control.
Sure. Well, we're right at the buzzer here, Billy. Thank you for your time. Maybe we can wrap up with just one final piece of advice. It could be professional advice, or it could just be life advice from a mentor. So whatever you want to leave us.
No, I think it's great. I mean, it's awesome that you're doing this, these segments for the community. I think what I've learned is all of these deals and all the relationships. One of my mentors, really early in the quant world, and has built a great fintech business, said it's a contact sport. And so I think if you want to find deals and you want to raise money, I think you have to be off Zoom. You have to figure out how to get in front of people. And I think that people who appreciate that and invest in that will have a lot more success than the ones that are on Zoom and having twice as many meetings. So we've really tried to prioritize that, especially as we look for deals. And I think we've seen a big uptick in quality and number of actionable deals by kind of getting back to in person with people.
I totally agree. I mean, I know we're at time, but one thing I want to say is, I knew somebody that was like 15 years younger than me. And this person, I met him at one event, and I'm able to get away to one event a week, maybe, or one event every 2 weeks. And he's like, yeah, Joel, like I live in New York and I go to like 5 events a week. And I'm like, man, you probably have like a crazy compounding network. So I think just getting out and meeting people, talking to people, some of those things turn into, multi-year relationships. And some of the people that I mentioned, when we met, Billy, and you probably did the same. I've known those people for, close to a decade now, but we met at like some fintech happy hour or something like that.
Yeah. So, but you have to like reinvest in that in-person element.
I totally agree.
Because it just, I think a lot just doesn't happen if you're on screen, but you have to be really then purpose built around like, I'm going to Austin next week. Like, who can I meet with? How do I plan those meetings now? How do we think about planning events in the future? And I don't know. I think figuring out like sales is just, everything we do is sales.
Mm-hmm.
And getting your wife to say yes, sales. Getting an investor to say yes, sales. So I just think it's hard to do sales if you're not in person, but then you have to be smarter. I'm sure AI can help and how you keep track of your relationships and keep track of what people's interests are. I mean, I'm excited about AI because like even how you take notes or how you transcribe this podcast or, I think there's just so many things we're wasting time on, but hopefully then you can use that time for in-person.
Sure. I totally agree. Well, hey, Billy, thank you for making time for us. I know you're super busy, so means a lot, and we'll catch up soon in person.
Absolutely. Thank you for having me.
Yep. Take care. Bye, everybody.